Hi everyone, thanks for tuning into my channel, All Things Accounting. Today we are going to be dealing with part 3 of a 3-part series which involves inventory costing methods. In particular, we're going to be looking at LIFO method. So stay right there and we'll get through this together. So the LIFO method, unlike the FIFO method in part 2, when we sell inventory, it's going to assume that the last inventory that we sell is going to be the first to be moved out. One of the problems with this method is that it tends to keep the oldest inventory on the books. So it might be outdated eventually if it takes a long time to move that inventory. So if you hadn't seen my other two tutorials on inventory costing methods, I'm just going to go through this briefly just to lay this out here as the basis of our numerical example. So let's say that ABC company has an opening balance of 500 units from prior years that's carried forward. Throughout the year, on January 20th, 8th, September 5th, and December 12th, they purchased additional inventory units for those amounts at their respective prices per unit, and therefore these comes out to the total cost. Therefore, our total available units of inventory for sale throughout the year is 1,500 units. We sold about 900 units throughout the year, therefore that leaves us 600 units ending. Now, let's say under the LIFO method, it's the last in, first out. So if we sold 900 units, we're going to go from the last units that we purchased and assume that the 100 units purchased on December 12th was sold. The 200 units on September 5th was sold. All 400 units on April 8th was sold. So that brings us up to 700 units so far, 400 plus 200 plus 100. And therefore, if that gives us 8, then we need 9. So we just need 100 of the units purchased on January 20th. So if we look at this, working backwards, December 12th, okay, so we need all 100 units of that. That would give us $1,400. On September 5th, if we sold all 200 units, that's $2,600. On April 8th, we sold all 400. That would give us $4,800. And remember, that's $700 already. So we sold only 100 units on the January the 20th. Sold 100 units at $11 per unit. So that's $1,100. Therefore, if that's what we sold in total, 900 units, therefore our cost of goods sold in this case would be $9,500. So, because under there, we are assuming under LIFO that our last inventory is being the first one to be sold, now that we've computed it, then we could say debit cost of goods sold, credit inventory to reduce our inventory by the cost amount for which it was sold at of $9,500 with an explanation down here. So I hope that explains the LIFO methodology of inventory costing for you. If you found this tutorial to be useful, please subscribe to my channel and hit that like button and hit that bell notification icon so that you're always up to date on the new tutorials that I'll be posting. Till next time, take care.